action in action. We've got Tom Karsten with us, Karsten Advisors, President and Chief Investment Officer, who thinks the market is headed for a pullback. Jim Awad, Zipper Management Managing Director, whose two stock picks from last time are both up. You go, Jim, 12%, over 12% in the past 2 months. He's back with 3 more ways to play the market. And Larry Shover down in the pits of the CME. Larry, let's start with you about today's market action. Not a lot of volatility, which was nice to see, but certainly, we continue to kind of wait on the Fed. Or is that storyline past and you're watching something else?
I think it's a lot of things, actually. A very jittery day with a million headlines and a ton of apparent reasons for every move in the stock market right now. One thing we have seen is a genuine uptick in hedging and risk-off action. A lot of that might be the Fed. Some of that might just be year-end squaring of positions. But when it comes to tapering, the traders behind me are realizing that it's not that big of an overhang. If it was, we wouldn't see gold, treasuries, and home builders do so well today. So at the end of the day, a lot of consolidation, a lot of confusion.
Yeah, people taking rise off of the Fed, looking at other things like new regulations. Tom Karsten got a whole new group of banking regulations as part of the Volcker rule. Started out as something simple, typical of Washington. It's now 1,000 pages, a bunch of legal gobbledygook inside of the thing, and yet banking stocks didn't crash today. In fact, some of them did very well. Why is that?
Yeah, I think that we really didn't see as much disruption today as many people were anticipating with the passage of that rule. And I think a lot of investors were expecting that's been in the writing for a while. We've got investors who still anticipate that while there will be a taper, we're going to very likely have very low interest rates well into 2014. And as long as that's there, it's still a little bit of a party for stocks and really not causing as much disruption for investors as you might think.
Well, but Jim Awad, you think that, you're still bullish on stocks overall for 2014, but there's 2 restrictive factors that you're concerned about right now. What are they?
Well, you've got tremendous speculation in the credit markets, almost as bad as 2007. There's a lot of low-quality paper out there, and I'm afraid that some people might have gotten access to money that shouldn't have access to money, and as credit conditions normalize, they may not be good for it. And secondly, you have to say that valuations, the cheap day in the stock market is over, and you're somewhere between fair valuation to a little bit over fair valuation. So those are the 2 factors that keep me a little bit restrained.
Although, Jim, it's interesting that 2 of your picks, you have some stock picks you brought along, are business development organizations. Yeah. These are organizations that give out loans. They're kind of a mix between private equity organizations and banks, right?
Right. And of course, they're not without risk, which is why you get an 8.5%, 9% dividend.
Wow.
But these 2.
By the way, you own these, right?
I own them
these 2?
For my clients and for myself and for my family. And what they do is become very hard to get money from banks. So this industry has developed and grown up, and they sit on top of the balance sheet. They lend money to medium-sized corporations, senior debt, and variable rate. So they are reasonably well protected as long as the economy is expanding. And if you believe the economy is still going to expand, these sell at book value. And as I said, the book value grows and they yield 9%. So they're prudent plays, but you do have to stay on top of them.
And Tom, talking of plays, you actually are looking at the alternative investment space, which, honestly, we've seen this bond outflow in the last 3 months, but we haven't really seen the equity inflow we should have seen. Alternative investments, right. Where's the money going?
Well, we think that's going to be a bigger trend even going into 2014 because we've got a lot of our investors who are near retirement or in retirement. They need income in their portfolio, and even with the generous return you've seen in the stock market this year, they need income-producing assets. And alternatives by their nature, whether it's in real estate or oil and gas, are very much income-oriented. And we see those, and I think investors are seeing them, as a replacement for bonds in the portfolio moving forward.
Larry, let's talk about commodities for a second, because we see this spike in oil. Oil is very close to $100 a barrel. Is that because there's a general agreement that the world economy is getting back on its feet, or what?
Chicago guy. Yeah, David, that's definitely part of it. It's another thing where it's positioning. Traders are expecting that this week's EIA inventory is going to show 2 weeks of consecutive drawdowns. Remember that super congestion story we talked about last week and the week previous. We have pipelines now, the Seaway XL, starting to move a lot more oil than anyone expected. It's going to start to drawdowns faster and very furious to refineries. All of a sudden, we're going from a glut to having not enough oil is going to cause the price to go up. And you can also see that spread between Brent and WTI coming in quite significantly, about 6 points in the last 2 weeks because of that lack of congestion.
You know, Tom, some of the stock plays that you've been looking at, I think this interesting is technology. And technology and financials, two of the strongest sectors for 2013 performance. But within technology, do you have any concerns about specific names or a favorite name you can tell me about?
You know, in general, I think that our concern is a lot of the momentum names that you've seen, whether it's been a Google or a Facebook that have seen strong gains this year, really don't have, I think, the staying power this next year to move forward. And also, you know, to Jim's point, I agree with his comments on valuations in that it's very difficult to find companies at attractive valuations right now if you're putting new money to work in the market.
But Tom, you like Cisco, don't you? You like Cisco.
We do, and that's a perfect example. You're exactly right, Cheryl, of the areas where we do see it. We think with a company like Cisco, you've got a lower valuation, a sustainable dividend that they're paying out, and really kind of a backbone of that sector that we think should have some upward potential in 2014 as well.
Jim, we've seen some encouraging news about the economy. Of course, the jobs report, some other good news from the Federal Reserve. If the global economy, starting right here at home, is really beginning to grow again, wouldn't you be making some kind of play in commodities right now?
No, I don't think that the underlying growth, anybody's forecasting underlying growth to be strong enough to restart the commodity cycle. It's going to be better. It's going to be better than it has been for the last couple of years. But there are enough restraining factors around the world that you don't want to bet on inflation. You don't want to bet on super growth. You want to bet on moderate growth and durability of growth.
But Jim, you like GE.
I like GE as a stand, but there's a huge long-term margin play, plus a dividend, plus they cyclically benefit from the recovery in the world economy.
Jim, by the way, Apple, last time you were here, you bet on Apple. It's up 14% since then. That was only 2 months ago. Are you still with Apple, or did you sell?
I think it's got another 10 or 15% to go in the holiday season.
Wow.
Really?
Cool.
I think so, but I think when it gets there, that's the game.
Jim Awad.
Yeah.
Bold prediction. Jim Awad, Tom Karsten, gentlemen, thank you so much.
Great
and of course,
stuff.
thank you
Thank
to
you.
Larry Schover as well.
Thanks, guys.